If you just sold your business and had $10 million, how would you invest it? Well, I had the privilege of giving a presentation to founders who are exiting their business on how they can invest some of their money into real estate. Now, a lot of times these founders have been focused on their business for 3, 5, 10 years, grinding away, and now they're getting their big payday, and they want to get into the world of real estate investing because they know it's a great way to preserve capital, but also grow their capital without them having to work 80-hour weeks anymore. So today's podcast is actually a recording of a presentation I gave with Tyler, who's an expert in the industry. So Tyler, a few years ago, exited his business, took a lot of his money, invested in real estate, and now he helps other businesses go out there and scale and then exit. So hopefully you enjoy this presentation. If you have any questions, let me know.
Thank you for joining. I wanted to put this show on for any founders or any friends of my founders that are actually experiencing an exit that wish to preserve and grow their wealth. I went through this entire space and journey myself, and being able to have something like this accessible to me would have been extremely helpful. So I hope you enjoy. So I want to take this time to introduce Chris Lopez. He's the founder of Property Llama Capital. And of course, I'm Tyler Horsley, CEO, managing partner in Nuclear Capital Group. So we met through mutual acquaintances from EO and YPO, Colorado. We're actually conveniently 3 minutes apart as well. Our offices are super close, stumbling distance.
Yeah. And thanks for having me on, Tyler. I love obviously talking about real estate investing, and we really hit it off based off of obviously we both invest in real estate. I've done a lot of marketing. Obviously you have a lot of success in marketing as well. And we got nerding out on marketing and funnels and nerding out on real estate. So it was a lot of fun. Yeah,
it was fun. And it was also surprising too, right? In the investment environment, meeting other marketers who understand sales funnels, automation, and more. I was like, wow.
Well, that's actually when I realized when I got into real estate investing years ago, because I was trying to figure out, hey, how can I always want the cheat code in life to go out there and have as much success as quickly as possible. Mm-hmm. And, real estate's a very old school, analog, frustratingly slow business. And I had built a good internet business, and I was like, oh, wow. People in real estate really suck at technology. Yep. They really suck at marketing. This can be my way and go out there and get my cheat code by helping some of these very successful real estate investors. I can bring my marketing and my tech skills on there and kind of have them be my mentor, but also be their right-hand man. Yep. And that was my cheat code.
That's a really good position. I've seen, obviously we all know, real estate's relationally driven, but it's not scalable too. In some certain circumstances, you can have all these relationships, and I would also imagine like sales funnels and more, just optimizing that communication, being able to be more present in front of those people is quite helpful too.
Yeah. Real estate is still very much a belly to belly type business. Like one-on-one and phone calls and meetings and small group stuff. It's not the, I'm going to do an A/B split test and, drive 3,000 people this page to figure out stuff.
Is belly to belly a term?
Oh, yeah.
I have like this mental image. It's pretty great.
Yeah. That, keep that mental image to yourself.
Perfect.
I say it as one-on-one. But Tyler, spend a little bit and talk about your background here, because one of the things that I was so impressed with is not just like, okay, first, hey, you're investing in real estate. And then as we got talking more, hearing about your background and what you did. And I was just like fascinated. And also I love hearing success stories.
Yeah. Yeah. Happy to. And it's fairly eclectic and odd, right? From government and stuff I did in the past, but related to kind of what we're talking about today. My technical term is an EIR. And so essentially I work on the private equity and venture side. We will do capital raises, invest our own capital. Again, I work with founders like myself who have had exits and more, but basically go buy companies. So mine, just marketer to marketer, what I typically do, I do what's called an opportunity analysis. So I'll look at organizations that are for sale online through M&A partners and more. And I can see every search term online, search volume. Are people even looking for this? So instead of just going and winging it and buying a company, trying to make it better and grow it, we can kind of see behind the scenes a little bit. So that's kind of my role. With that, of course, I create capital through successful exits and through growing successful businesses and then invest that capital.
Yeah. And that's, talk about your investing thesis, because you had your exit, and then I was really impressed with how you kind of like divvied up your money.
Yeah, and by the way, I think it's worthwhile for listeners as well. A lot of what drove that thesis was because I had qualified people around me who knew a lot more, hence this show.
It's one of the keys to life. Surround yourself with smarter people.
It is, right? One of my methodologies to life is highest and best use. So it's like, what is my highest and best use? I'll be an expert in this specific niche. And if I can create a tribe of others around me that have my back, and that's the most optimal way I have tested and can see to live so far. The investment thesis piece, even though I am very prone to private equity and venture, it is very fun for me to grow business. It's something that I understand well. I actually ended up doing a split 60-40. So of the entire amount that I got for my exit, I put 60% into real estate. So.
And you did 60% into real estate. What about the other 40%?
40% primarily venture. I guess venture, I want to be clear too, because there's venture capital, private equity. There's a lot of different layers here. Venture can be hit or miss with people thinking like, hey, this is a startup. Let's go buy 10, expecting 7 to fail. That is certainly not my investment thesis. Mine is I love investing in quality operators and then followed by good models. Like real estate, business is very relational. And then of course, when I can package that data on the back end and I know that there's like huge missed opportunities, maybe the previous owner never marketed or had these, platforms set up. Those are companies that I look at. And I've invested in friends' companies, some startups, but they're typically unicorns, AI, SaaS platform, high multiple exit stuff. So, yeah.
So why the 60-40 split? Like, was that just like, obviously you have an analytical brain with big marketing. Yep. How'd you come to that ratio?
Yeah. So I think stability, I've heard, when I say stability, I'll kind of clarify that, but, venture or private equity is highly reliant on certain variables and factors. Yes, you could do the best you possibly can on business modeling, marketing data, operator, and more. Economy takes a turn. That's outside of, your control. Certainly you could say that with rates as well in real estate, but I really liked the idea of, I call it kind of like a safety net. And again, this is just my brain speaking, so I'm not making any claims, but for me, I'm like, why would I put this money in a bank when I could put it in real estate that is just as good as a bank, likely way better, because traditionally real estate appreciates over time. A lot of these models as well, and I have a little bit of diversification in all types of real estate investing, but I like mailbox money too. I want to be able to be paid and or earn money for not working 80 hours a week like you do in private equity, right?
Yep.
So, yeah.
So as we kind of get into details on here, I was thinking like the best way to help describe real estate, and I'm always a big believer, hey, let's start with the very basics.
Yep.
So a lot of people are coming from like, selling their business or the marketing world. And a lot of times they understand real estate from a high level, but we'll start with the basics of real estate just so you can understand what the return profile is like. And then I'm actually going to walk through 4 examples of deals and actually break down expected returns, the timing of cash flow, and also how they fit in today's trends in the high interest rate environment.
Perfect.
So a little background about me. Again, my name is Chris Lopez, and I really focus on helping investors figure out how to balance their portfolio and invest in real estate. I got on the deal making side because I wanted to learn how to invest in real estate myself. And like I said, I did a fix and flip. I did some wholesaling, did a bunch of stuff where it wasn't working. And I realized, the highest and best use of my skill set was to go out there and bring that marketing and technology piece, which allowed me to go out there and meet so many great real estate sponsors. And then with the marketing component, I was able to drive more connections to them and also more capital. So I'm very good at connecting capital to really good deals. But a little bit more background, I think a lot of your audience can relate to here. And I got a chart up here of the Denver metro price appreciation to highlight like some of the growth waves, and we'll talk trends on here. But also I put a red line on there for when I read Rich Dad, Poor Dad. I think for a lot of people, that was like the catalyst for me.
Yep.
I'm assuming you've read Rich Dad, Poor Dad, Tyler?
Absolutely.
Yeah. I mean, it's light on details,
Yep.
but it's amazing on like the conceptual shift of like, holy smokes. And before I read Rich Dad, Poor Dad, I was actually going to Virginia Tech, and my plan was to ROTC for military, then go get a job in the government in DC and commute 2 hours a day. And it just was not exciting for me.
Right.
So read Rich Dad, Poor Dad, wanted to become an entrepreneur, wanted to become financially free to escape the rat race. So I got slightly obsessed with it, I would say. And then I was actually able to graduate college not needing a job. And that was through early internet marketing days. Like this was 2003 timeframe. So this was still like AOL CD-ROMs. And
I
think Yahoo was still bigger than Google.
The dial-up.
Yeah. Hey, Mom, can I get on the phone?
I know, right?
I don't miss those days. But the reason I bring that up is because as I had a really good business on there where I had a great lifestyle business. I had lots of cash flow. I also had lifestyle inflation where I did a poor job of reinvesting the capital I made. I made it, I spent it, and I had probably one of the best life a 20-year-old could ever have. Lots of fun on there. But when I got back and said, okay, it's time for me to move on this business, go on to something else, a common theme I saw out there was so many people I worked with, they owned real estate.
Yep.
And a lot of the wealthy people I met, especially wealthy people with good lifestyles, they had real estate in their holdings. Said, hey, you know what? I want to go out there and do that. And as I was trying to figure out how to get into real estate, reflecting back on what I did in the internet, my internet business, is I realized I worked hard. I did a lot of things right, but I also just rode a trend wave. Like I just rode a trend line.
Sure.
2003 to 2010, early days internet marketing. And it was a great day to go out there and just ride that trend. And I missed the Silicon Valley. I didn't have a big exit. I missed all that stuff. But like I learned so many skills and learned how to go out there and market effectively and use technology. And so I said, okay, I understand if I just ride the big freaking wave. If I just ride the big freaking wave, that makes up for so many mistakes in investing and business, right? So I got that business about 2010. And so this was, the real estate market had crashed. We had the financial crisis. The world was kind of still on fire then. Yeah. And the consensus was still, oh, you're going to buy real estate? You're insane to buy real estate. And I was like, well, prices will come up eventually. Like I'm going to go out there and there's going to be a rebound and I want to catch that rebound. So I really got into real estate in about 2011 and I really got serious about 2014. It took me a couple years to get my feet underneath me. But I really focused on more of the longer term aspects of investing in real estate, not how to go out there and make quick money with a fix and flip or wholesale a deal. That's all great stuff to do, but it wasn't my interest. I was like, how do I build long-term wealth? How do I kind of do like a Dave Ramsey, Warren Buffett approach? How can I go out there and in 40 years, I want to build that type of wealth. So I really focused on that longer term, I call it like real estate financial planning aspect of it.
That was your first swing at real estate. You started thinking long term.
Yes. Well, that's why I got into it. I didn't want to make the same mistake I did in my internet business. Right.
Did you have cash flow or anything? I mean, were you living on savings from your exit, or how did you kind of rationalize that?
So I had a lot of savings, also had a good amount of residuals.
Okay.
And this is one of the things I realized from, I escaped the rat race kind of on paper, and I had residuals from some SaaS subscriptions. We had a SaaS product, some affiliate stuff, and also some just, a bunch of like info products.
Yeah.
The thing with those is while real estate appreciates, your customer subscribers do not appreciate.
There's attrition.
Yeah, they're exactly.
So it's like a slowly, diminishing return.
Yeah. And so I had some good savings, cut my expenses, and also I had a very fortunate couple years of just really good residuals. I still have residuals today from that business. I mean, they're pretty minuscule, but I had residuals coming in to help me so I could kind of reorient my ship and myself.
Cool.
But what was interesting is a lot of stuff I started talking about, like no one else was talking about in the real estate industry. I got to have some great stuff on BiggerPockets, which is like the biggest platform out there, and start teaching more how to go out there, not just make a quick buck in real estate, but how to go out there and build that long-term wealth. So I'm going to go through, I have to give this disclaimer as my lawyer tells me. So I'm going to go through with a bunch of numbers on here. Understand I am going to be using numbers and data I've sourced myself. I'm going to be sharing some deals I've invested in, I've put together in, and some deals, we currently have going on. But I'm just kind of using these for examples' sake to go out there and model things. Not offering for investing. If you guys are interested in that, let me know and I'll get you the official documents. But I'm sharing all this for just example's sake. But of course, always talk to your CPA and your financial advisor. So Tyler, I always think the best thing to do when people start learning about real estate is just start with the basics. Like you work with a lot of, exiting founders. How many have a good understanding about how real estate actually works when it comes to like how you make money?
Not many conceptually at like 30,000 foot view, but I mean, if it's a traditional founder, they have just busted their butt like the last 5+ years. They can barely breathe. Yeah. They finally got an exit. And what they don't want to do is look to invest in something that just consumes their entire life again.
Yep.
So that was what was appealing to me about it. But I would love the basics.
Cool. So from a return profile, and I'm going to switch over, I'm going to start demoing a lot of software on here. So this is a software we have called Property Llama. And this is one of the software company that I built and we use to help actually people model their real estate returns. But I'm going to use this for a lot of the talking points and to model how real estate works. So there are actually 4 ways to make money in real estate. So there's appreciation. So the property value increases. Hey, you buy a property for $100,000. 10 years later, it's worth $300,000. That's the appreciation real estate. There's also debt pay down. So if you own a house out there and have a mortgage, you understand this. Hey, whenever you write a check to your mortgage company, some goes to your principal reduction, as a lot goes to your interest, and some goes to taxes and insurance. Well, if you're investing in real estate, you are writing a check to your mortgage provider, but who's paying it? Your tenants are paying it. Mm-hmm. And so every single month, you're usually getting a small back of your principal reduction. So when you go to sell the property, you have more equity in the property. Cash flow is the most common out there. Everyone thinks, if I buy real estate, I'll get monthly cash flow. And so that is the rents minus all your expenses. What's left over is the cash flow. And then the last one is depreciation or tax benefits. And this is by far the most complex part of real estate. And we won't really go into details on here because that is 3 webinars in itself to understand the basics. Yep. But we've all seen the headlines about, some real estate billionaire who pays a lower tax bracket than a secretary. Yep. They do that through depreciation. And depreciation is kind of like the phantom loss you get on your IRS returns. So it's not real money in your pocket, but it reduces your tax liability. Mm-hmm. So there's 4 ways to make money. Understand it's not just how much does this property appreciate. And please don't just look at it as cash flow because you'll miss so many great deals if you just focus on cash flow. And this is a good way to understand the deals too, is like there's really 2 sides to every real estate transaction, or almost every real estate transaction is the equity side or debt side. Equity is like the down payment people bring to buy the property, and the debt is usually the bank. You go out there and you buy your house. Well, hey, you put down 20%, and then Bank of America or your local lender, they're giving you the other 80%. So when you invest in the deal, you can either be on either side of it. And we'll talk about both, but I'll go through the highlights of there. I think if you invest on both sides of those deals, I know you've done the equity investments.
Yeah, absolutely. And debt. And then some, even with multifamily, we put down the money that they will be using for the down payment and we get a guaranteed return, like a fixed return or something like that. So, yeah.
Yeah. So there's a lot of great stuff you can do here in real estate. It's very creative. So equity investing, understand you get all 4 returns: appreciation, debt pay down, cash flow, and the tax benefits. Usually have a strong potential for the tax benefits on depreciation. Usually not liquid. You invest in a equity deal, it's illiquid for 3 to 10 years, typically speaking. Usually higher risk than debt. And then your returns, a lot of times, 15 and 25% annual returns are range you see on equity side. For the debt side, this is really like you usually get one type of return. It is all cash flow. And when I say debt, I mean like you are the bank. You're not Bank of America. You're not the cross-country mortgage, but you're a lot of times the private lender like you were talking about in your deal, or someone loans money to a fix and flipper. That's like, I'm going to be the bank for this transaction you're doing, which, traditional financing usually doesn't do. So you get cash flow on there, but it is usually double digit and steady cash flow, usually a lot more liquid. Anywhere from, a 6-month lockup period to longer. And after that, a lot of times getting back in 30 to 90 days. Lower risk than equity because, hey, if someone goes into bankruptcy, the creditors get paid first, but you're going to get a lower return. And a lot of times right now, they're about 8 to 14%. So I like to use a phrase called portfolio architecture. And this is how do you want to create your portfolio? You talked about you have 60% in real estate, Tyler, and 40% in private equity and business deals. Do you know how much you have on like the equity side versus debt, like percent wise?
No.
Oh, yeah.
I'd need to. I mean, I'm an LP on some deals, GP on others, and then have some private properties. So I wouldn't. No, I should probably know that.
Well, I put you on the spot there, but I mean, most people don't because, it's like, hey, well, I've got all this money invested in real estate. Right. And it's always this balancing of like, well, hey, if you want more cash flow today, you have less upside in the future.
Sure.
But the more growth or upside in the future you have, the less cash flow you have today. So
Yep.
usually for a lot of like, business owners exiting their business, they want to balance it. Hey, how much can I put towards longer term growth?
Yep.
More future money.
Yep.
And how much cash flow do I want today? And that's kind of balancing out that portfolio architecture. So as you're like talking with Tyler, or if we get the chance to talk, like start thinking about that. Because if you have $1 million to go out there, invest, wherever it is, think about, okay, how much cash flow do I need today to live off of or whatever? And how much can you put away for 3, 5, 7 years in a really solid long-term investment? Most people have a blend of both.
Yeah.
That's the vast majority of people. So I want to go into and actually talk kind of about some of the deals we do here at Property Llama Capital. So that is a capital raising group I've put together where we go out there and help connect investors to really great real estate sponsors. And a sponsor is a fancy term for like the people that do the real estate deal. And so what we do here is we put the deals together, and I will give you a high level for our investment thesis. And a lot of this just goes on like my own investing. So like part of the reason I put together Property Llama Capital is because like I'm a deal junkie, and kind of like what you're doing with your stuff. You get in there, you find a great business, and you're hands-on, you're investing, you're bringing other people's money. I do very similar things just on the real estate side.
Yep.
So I'm a big believer in like following the trends. Just follow I call it the BFT, the big freaking trend. Hey, where's that big trend? If you follow it, that's like 80% of the battle. Look for opportunities. Where are the opportunities in the marketplace? And since real estate is a very inefficient market, it's not the stock market. It is not crypto. It is not online marketing. It's not drop shipping. There's a lot of opportunities out there that you can go out there and find. And also, I'm a big believer in diversification. Don't invest all your money into like one deal, one sponsor, or one market. You want that spread. If you kind of think of like an S&P 500 index approach, you want it spread out across at least a few different investments. But the most important rule is preservation of capital. Rule number 1, don't lose capital, don't lose money. So everything we talk about here, we'll talk about all the other stuff, but it's all about, hey, how can we have a very good return profile with a very low downside profile? Now, when I invest in real estate, my personal goal is to double my money every 4 to 5 years. And that's between cash flow and also selling properties. And that's a very common rule of thumb I see most real estate investors follow out there. I didn't make this up because it sounded good. I wrote it down because I met all these people, my mentors, who are much more successful, much wealthier than me. Yeah. And that's what they targeted. Yep. And as I started learning more about their portfolios and deals they were doing, I was like, oh, well, that's a very common trend where you can realistically do that. And you can consistently do it as well with a pretty low downside on not losing money. So, and as you talked earlier, like this is not like venture capital where it's like zero or hero. Hey, go out there and invest 100 companies and then you have one Facebook. These deals, they all should have a high probability outcome of having the return you expect. So moving on to the fun part of the presentation. What's working in today's high interest rate market? And I want to really emphasize that we're talking about the high interest rate market in 2024 and beyond, because we are in a different market cycle. If you were in real estate investing in the 2010s, or you have friends that did it then, understand that is a completely different market cycle, and we're in a brand new one. So what worked then does not work today. And again, I'm bringing up this chart here to show the 2008 crash in residential prices. Now, this is a price or a chart from a Denver Metro, where I live and where a lot of my investing started out here. A lot of other markets look similar to this as well, where, hey, we had the crash and this huge growth wave. That's the BFT. That is the big freaking trend. And anytime we invest, I mean, no matter what you did on here, if you invested along this trend line, you're pretty much a genius, right? It's hard to lose money when the trend was going up. Double-digit appreciation, double-digit rent growth. Everyone looked like a genius. So understand now in residential, we are not seeing any crashes out there. I mean, some markets are seeing a little bit more softness than others, but nothing like the 2008 meltdown. Right. And then actually, like most markets, they're kind of seeing flat growth, and actually we're already seeing like below average appreciation. So that big trend is over, just meaning, hey, there's no huge opportunity or no big like buy low, sell high type trend. But I think you'll know this one. Interest rates rose. All the residential people have their mortgages on 30-year fixed, and the people past the 2008 crash, they had very high credits. But where is the pain coming in the high interest rates? Or what pain is the high interest rate causing?
Oh, I mean, it prohibits or makes super difficult, situations for new home buyers.
Yep.
And more. I mean, people that are stuck in or locked, luckily, in the twos, right? Twos and threes at 30 years, like they're doing okay. But new home buyers, like the transaction volume has come down significantly.
Yeah, that's come down a lot.
Mm-hmm.
And then residential is usually 30-year fixed.
Mm-hmm.
Commercial, meaning everything that's not a 1 to 4 unit, is not fixed. They're anywhere from like 1 month floating to like 10-year fixed. Most are like 1 to kind of 5-year fixed.
Right.
And that's where a lot of pain is happening right now. So land, obviously office space.
One of those or 2 of those.
Yeah. Feeling some pain on that, right?
Absolutely. Where burn and, management and all these things that you're paying is outweighing the actual, return.
Yeah.
So,
and that was just, kind of what happened with that market cycle, because since those are on 30-year fixed interest rates, there's a lot of pain on there. And not to mention, we had all the COVID supply chain issues. Insurance has skyrocketed. Taxes have gone up. There's been a bunch of factors. So what this chart is here, and I haven't shown you this, Tyler, so we can nerd out on this for a second. So this is, again, Denver multifamily here. This green line is 2 to 4 units. So duplexes, triplexes, and fourplexes. And it shows, hey, prices dipped a little bit in the 2008 crash, but nothing like residential. And they've been consistently growing. And then in 2022, interest rates started going up, and we saw prices dip a little bit, and now they've flattened out and, slowly coming up again. This dashed line here on the bottom, these are commercial multifamily, so 5 units or more. And that is the delineation in real estate. If you're 5 units or more, even though it's a residential building, it is a commercial asset for lending standards. So you can see here, prices actually really didn't crash in the 2008 meltdown. And that was a big selling point of multifamily the last 15 years. And then prices were going up. And then right here in 2020, when interest rates went to basically zero, you can see prices just shot up. I mean, it looks like a pyramid. And then at the end of 2021, interest rates started coming up and the prices dropped. And so this is where we're seeing the crash. You talk about opportunity. Here's the opportunity. We're buying multifamily properties back at like 2018 prices right now. And then, will prices keep crashing forever? No. They'll eventually stabilize. They'll eventually come up. I'm not sure when, but I know they will. And I think most of the pain is over as far as like the big drops. So all this chart is Denver apartment buildings. Understand this is how most markets look, and very similar across most asset classes. Apartments, land, just a lot of commercial. We have seen prices drop because their income performance is so directly tied to interest rates. And then all the, taxes and insurance really was a kind of a triple wallop for these guys. All right. So I want to go into the first of our 4 examples. And I'd say a very classic real estate investment is multifamily value add. And so I'm going to do a case study on a property that I put together, I invested in. And actually, I want to show you, like, we bought this in November 2022. So the market is still going down. We bought it while the market's going down because it's a good deal. Now, what multifamily value add is it's not building a brand new building. It's going out there a lot of times buying a place that's built in the 60s, 70s, or 80s. So it's a good building, good bones, but now it's just outdated. A lot of times it's had the same owner for 20 or 30 years, and they've gotten a little lazy, so it's not up to date anymore, or it's below market. And so therefore you can go in there and add value by updating the units, updating the exterior, bringing some modern amenities, and then raising market rent. So this was 2 17-unit buildings about 15 minutes north of Denver. So great location and 34-unit building. And so it needed about just under $1 million to go in there and add the value. And that was to take care of all the exterior stuff and then turn all the inside units. But the building, when we bought it, it had a blended rent of about $815 a month in rent, which, for Denver is very, very cheap. Oh, yeah. That's what you can rent a room for. And then the plan was to bring it up to between $1,300 and $1,400 a month in rent. And so actually we've done that, and we have the average about $1,350 right now. So we were right in that range. And so a lot of it is here. You can see the before photos. The property is not bad. It's just ugly and outdated.
Right. It's outdated.
And then all the new modern amenities here where, hey, it's brand new. It looks good. Even put a dog park in here, threw up an accent wall.
Yep.
So this is really geared towards workforce housing. So great property, clean it up a lot. And so when you look at properties like this, and I'll go through the return profile in a minute in Property Llama, but a common term you'll hear is internal rate of return. If IRR, if you don't know that term, don't worry about that. What that means is how much money can expect, how much of a return can you expect to make a year. Now in multifamily, usually about 15 to 18% is a pretty common range. Sometimes a little bit lower, sometimes a little bit higher, but that is the range we're shooting for in this property. And I am going to go back over the Property Llama software. And so what I did here before I jump into this is I'm going to talk about the 4 investments. And I put $1 million in each one of these investments for simple hypothetical returns, a nice rounded number so we can see it there, what it can generate. And so you can learn about the timing of the cash flow as well. So I'm just going to go over here and pull up the multifamily one. And then while this one's not exactly Samuel Drive, like I talked about, it mirrors the performance of it. So put $1 million into here, and what you can expect in year one is usually 0% cash flow and 0% anything, other than you'll get a lot of the tax benefits on depreciation, which we don't have modeled on here. I'm just gonna keep really focused on cash flow and equity growth. But year one is 0 cash flow. And that's because, hey, we're going out there and it takes time to find the property. It takes time to buy it, and they have to go in there and you have to move some tenants to different housing or move some units around, then go rehab it, update the units, market the properties, and then get new tenants in there. And for most buildings, that takes about 12 to 18 months to fully do that. And then it's starting to get stabilized, meaning, hey, all the units are updated and pretty much all the tenants are now market rent. So year one is usually 0 cash flow, but a lot of equity growth from buying the property, adding value to it. Year two, we usually target, it's usually between like a 4 to 6% cash on cash return the first year. So this one is 5%. So, hey, $1 million in, by year two, you'll shoot about $50,000 back. And these are usually quarterly distributions you'll get paid. So, once a quarter, you'll get your pro rata share of it. And if you'll Samuel Drive, we brought about $1 million to that deal. And our distribution for year one, actually the first one this year was like $48,000. So right at that target, we were like a 4.8% cash on cash return. So right on target for that. And then years 3, 4 are pretty just steady Eddie. You're just owning the property, doing minor updates, keeping the units looking good, getting new tenants in there, and it's just a stabilized property. And so usually years 3, 4, and 5, it is fully stabilized, meaning you're just going to collect between like a 5 to 8% cash on cash typically. And see here, year 3, it's at 6%, so about $60,000 in cash flow. Bump the rents, $70,000 next year, $70,000 the year after that. Now, most multifamily projects have like a 3 to 6 year lifespan, or like business plan is usually typical, with 4 to 5 being, I'd say, the most common. And that is because, hey, we're going to buy the property, we add the value, we collect the rent for a while, and then years 4 or 5, a lot of times we sell the property to like somebody who's not a value add player, but an institutional buyer or a family office or a high net worth individual just wants to park their cash.
And that's when you see the most growth in those properties. That's pretty common in private equity too. We do 3 to 5 year sprints on businesses.
Is it really?
Yeah.
Oh,
yeah. Interesting. Plus, you have like a cap table. You have investors who they want the splash, right? They're getting the mailbox money, but they want that equity too.
Yeah, and that's where you usually get like the biggest chunk of cash from. Where like when we sell the property, that is where usually the vast majority of our profit is made, and that's when the vast majority of cash hits your bank account.
Right.
Now, the nice thing is that's usually taxed as long-term capital gains, so it's a lower tax bracket.
Yep.
That's probably the same way as for private equity too, then, right?
Yeah.
Because it's a more than a 1 year hold.
Yes. Yeah, and there's different layers. I'm learning this side obviously, but it's so is this true for LPs, GPs? Is this for direct? You talk about like depreciation or things of that nature. Are limited partners able to benefit from depreciation on properties as well, or is that primarily?
No, everyone can. So
everyone can.
To unpack some of these terms, so you talk about the general partner and the LP. So general partner, they're the people putting the deal together. They're operating, they're doing all the stuff. So they're putting the deal together. And probably like private equity, hey, they collect some fees to keep the light on and pay the bills. but most of their profit comes from performance. Hey, if they hit certain benchmarks on the returns to the limited partners, it's a waterfall.
Yep.
That's where the vast majority of their income comes, and that's why people do the deals, just like you do. Like that's where you make your big bucks. Now the LP, it's very similar to being basically like a stockholder in a company.
Sure.
You write your check. You really have nothing to do other than collect your checks. And the worst case could happen is you could lose your investment, just like if you invest in private equity or if you invest in the stock market, it can go to zero, but all of that check could do for you is go to zero.
From my perspective though, I mean, if you're a private equity or a business person, that could always happen. For one, this is at least an asset.
Yeah.
So it's like, it could go to zero, but you also are investing in in a fixed asset or an asset that's not there, not just a business idea dependent on, an operator doing well. So, yeah.
And then you do get all, like as an LP, depreciation passes through to you. You get all like those 4 types of returns. You're just not directly operating it. You're just an limited partner.
Lovely.
Yeah. Which, I mean, for a lot of the people that are like, what the GPs are doing, they're the equivalent to what, the founders you work with. Hey, that's what they do. That's their specialty. They've got a 10-person, a 40-person team. They've got all their processes built. Like that's what they do. And that's what their highest and best use of time is. But they need capital from other people.
Yep.
You have capital, but don't have the specialty or the time. Well, that makes it a good partnership.
Yep.
So, all right. So this is an investment one example that works really well. And just so you guys know, the majority of my money, I invest into multifamily value add. They're not the sexiest plays out there. They don't necessarily give the highest returns, but I think from like a risk-adjusted basis, these are some of like the best plays out there.
You get that quick equity bump too once you're essentially flipping it in a nice way.
Yep.
Taking a C class or maybe a lower value property and bumping it up, making it look nice. And
like I said, that the property I use an example on there, I think the purchase price was either $4 or $5 million and then $1 million and like the hard cost to fix it up. And then we should exit for just under $8 million.
Nice.
So it should be about a $3 million gross spread on there. Obviously there's some cost and fees in there and all that stuff too, but and that all comes from increasing the parents of the property, but those properties are valued off the income they make, just like a private equity business. Hey, the cash flow is higher. Great. It's worth more. All right. So going into the second deal. And so I'm going to talk about a couple development projects on here. And so this one is a 12 permit ready building lot. So 12 single family homes to go from ground up. And it's also following the green trend. So 2 things on here. Development is a really good opportunity right now because land values have dropped a lot. And so developers, I know they're like giddy right now with what they're seeing in like land value. Plus their supply chain costs have really stabilized. They don't have all the crazy cost and, I can't find this part from the COVID stuff. So it's become very attractive right now. And then this builder in particular, they really focus on green housing as well, like following the green trend. And so I'll talk about both of those. So here's a picture of the project. And this is actually way up north in Denver. So off of 285 up here. And so addition from like their track record and their green build, they're also building 12 more houses around 4 they've already built. So they know this area. They know this very local community. So we can add 12 more properties to the 4 units they've already built there. So that reduces the risk. And then this is just the plot of it. So we won't go into that. But here's a chart of their green building. So you can talk about their houses on the right, and it checks off a bunch of these check marks on here for, green housing, energy efficient. And so that's attractive from a couple sides because they get some attractive, financing deals and some benefits on that. But also a lot of buyers are attracted to it, whether they are environmentally conscious or not. And the day is their utility bills are very, very low. And a lot of people want to buy an environmentally friendly house. And also they want to keep their energy costs very low as well. So what this looks like, I'm going to go back over here to Property Llama and pull up this modeled $1 million investment. And so invest $1 million into here. So cash flow in year 1 is 0. Why? Well, it's a piece of dirt.
Right.
And then, year 1, a lot of times getting some permits done, the building plans done, stuff approved to the city, may start building in year 1, and the year 1 may start building in year 2. Year 2, cash flow is typically 0. Why? Well, they're still building. And then these are not units that are going out there to build to rent. These are single family homes that are going out there to build to sell. And then usually at the end of year 2 or sometime in year 3, the properties will sell. And in this case, hey, build the properties and then sell all 12, and that'll be to 12 different individuals out there, just, owner occupants, Jane and Bob and their dogs and kids are moving there and buy the house. So zero cash flow. And then year 3, you basically get the cash flow comes from selling the properties. Now, a lot of times you're not going to quite double your money in these deals in 3 years, but you're going to have a 3-year pop. And so I like these because looking at the trends on here, land is cheap. Green building is very friendly right now. And we are in a huge shortage of housing, just not in Denver, but across the country. It's like 5 million homes we're short. And then no one can build, it's very few people can go out there and build homes. We can't build them fast enough. So we have a very good exit on there too, where we know there are buyers that want the properties and we can comp those pretty easily. So in this example here, and this is based off of, real numbers on here, invest $1 million, and then year 3, you'll get about $1,900,000 back. Meaning, hey, $1 million is your original principal, and then $900,000 is the profit. So I call this like lumpy cash flow. A lot of times we think about cash flow like, monthly or quarterly. Well, in real estate, you get some of that, but especially in development, you get lumpy cash flow, which is 0, 0, 0, then a giant check, and then 0, 0, 0, giant check. And so this is a 3-year deal, and you get all your money back, and that's it.
It's a question for you.
Yes.
On, if I'm speaking to a founder or somebody's listening to this and they've had an exit, if you don't need the cash flow right away, like that looks wonderful, right? Are you using the initial money that the investor puts in as a construction loan, or like what type of, how's that capital allocation look on the GP side?
So it depends on a lot of factors, but a lot of times it's used to help buy the land and then fund the construction and then be basically the down payment on the construction loan. Okay. Now, this is not an all cash deal. They're still going to go out there and leverage anywhere from 60 to 90% LT loan to value on there. And so that's going to kind of go from, hey, buy the land. And depending on when they buy it, they may have to entitle it, which means they have to just get a bunch of paperwork done so they can build on the properties, and then fund the construction loan, fund development cost, fund the architects, and you're funding the whole project that way.
And I can just from personal experience and all of the legal that you said earlier, but it's like, I did one of these. 2 of my buddies from EO Forum, we went out and did kind of a scrape and build. And so we took this old lot, and put it down and basically did like 2 residential mini mansion, like duplexes. Yeah. You've seen those. And I think we were in for like 1.1 or 1.2, and both of them appraised at like 2.6. Like it was quick value, which is nice. We're doing an STR play on that. Maybe we should just sell it and do it again.
Well, I know the area you're talking about. If you can repeat it, I mean, that comes down to the niche on there. And like, understand like these development, like it is probably it's definitely one of the sexier things in real estate. Yeah. And I'd say, but you want to make sure you have someone that knows what they're doing. Yes. Because like, hey, if you buy a piece of dirt, there's a lot more that can go wrong. That I already have an apartment building on there, or there's already income coming in. So make sure you're investing with someone that actually knows the plan. It's not their first rodeo. Yep. That should be for everything you invest in real estate, actually. Agreed. So I want to go to the third example, and this is another development deal. And this is a Class A multifamily development. So I have the title on the slide here called Location, Location, Location. I think everyone's heard about that in real estate. And that matters so much in real estate because you don't have a good location. Well, a lot doesn't matter. So what this is, hey, buying dirt or buying a piece of property in a great location and going out there and building a big apartment building. So this is not a single family home. This isn't a townhome. It's going out there and building an apartment building that will build to rent and eventually sell to go out there to like an institutional buyer or family office. Now, here's a picture of what that property is. See, this is just the Adobe Photoshop mock-up of there, but 3-story, gorgeous looking property. And what I like about this play is a couple things. Number one, it's a great location. And so I call it like a Class A location. Now, a lot of times that's been meaning it's like a downtown location. Well, downtowns are not the best things right now. So this is not a downtown location, but it's in the very like affluent, trendy, urban neighborhood.
Mm-hmm.
If you guys are in Denver, it's like, Platt Park, Wash Park, these are where it's just a very
accessible, right?
Yeah.
I mean, you can
it's primo
miles away
location.
from like light rail and
Yeah.
stuff like that too.
Like the average home price there is like $1 million plus.
It's a great location.
And so it's going to be like a premium rent, a premium tenant. And then they're going to really enjoy, they're going to pay top dollar for like a great location,
Yeah.
also just a great product. And the sponsor that's building this that's what they specialize in, like customizing these projects. And I'm going to flip back over to Property Llama to model this and kind of show you cash flow. And so the other thing I like about this deal a lot is this is what's called a covered land play. So like in the single family housing example I used previously, hey, you went there and bought a piece of dirt and there was nothing and you built it. Well, when they bought this, there's already, I think, a 20 or 30 unit apartment building on there. Now it's outdated. It needs help, but hey, there's tenants on there and it's bringing in money. So while they're working on their plans, they're going through entitlement, they're getting everything approved by the city, the property is cash flowing on there. So in this example, in year one, it'll be very small cash flow, but it's something. Year two, some cash flow. And then usually right at the end of year two, year three, the property will start going vertical, meaning, hey, knocking down the old building and then building a new building. So this is where the cash flow will disappear because you have to go out there and build the property. And then year four, the property should be built and it should be starting to get leased up. And so start seeing around a 6% cash on cash return on there. So if you invest $1 million, that's going to be like $60,000 a year in cash flow. And this is projected to be a 7-year hold, meaning that, hey, they're going to, they bought the lot, they have that existing apartment on there, and they're going to collect the rents for a bit, then build a new place, and then hold on to it for, probably 2 to 5 years to collect the cash flow and also let the property appreciate. And they'll exit in year 6, 7, or 8, to an institutional buyer that just wants a turnkey asset, prime location, Class A quality, and that's going to be, a great exit. Now, I consider these projects a little bit, less risky because you're buying in a Class A location and you're, it's less risk because you're not in like, some tertiary market or some high risk market. You're in a very low risk market. So if it's lower risk, you usually get lesser return. Mm-hmm. So by the time you exit in year 7, you'll get your cash flow back plus the big exit from selling the property as well.
Quick question. When you go negative, or not negative, but when that cash flow moves negative year 3, is that traditionally a capital call with all the investors?
No.
Or is that pulled? How does that work?
So usually it should not be. Hopefully it's not a capital call from the investors. Most don't have it. Depends on the structure, but most don't. That's just they've already built that into like their pro forma or their business plan. Okay. So they've got some of the money they set aside.
Yep.
They've already got money set aside for it, and then they're also using a lender on there as well to help with construction costs. So there should be no capital calls, and most developers don't do it. They just collect all the money at once, so they have the money in the bank and they can run it. Cool. But that should not be like any negative impact on the investor. And so it's kind of already baked into the return profile.
Yeah.
All right, last example here is going to be talking about the credit side or debt side. So at the beginning of the podcast, we talked about equity versus debt. The 3 previous deals, the multifamily value add and 2 development sides, those are the equity side. You as the investor, we're putting money in there. And then for those other deals, a lot of times a big bank or a lender's coming in to help, lend the other money. Now, the last thing I want to talk about is what you can do on the debt side. I like to call it where you are the bank. And so this is a private money debt fund or hard money. And so what there's a difference between hard money and private money, but I'll keep it simple without going nuances on there. These are lenders that fill the need where non-traditional banks and non-traditional lenders will go out there and lend. And we're not saying risky assets. We're just saying typical loans, things that are like fix and flip loans where, hey, someone needs to go in there and buy a single family home. They're going to take out a loan for 6 months. And so hard money is usually quicker, easier, but you're going to be paying higher interest rates on there. Or if you want to go out there and for multifamily value, they go on there and they buy a property and they'll take a bridge loan for a year while they're rehabbing it. And then they'll refinance into a longer term financing with Fannie Mae or Chase. So this is private money or hard money that traditional lending does not typically lend to. And so a debt fund, I got a graphic on the screen here. So the private investors, so, people like, Tyler, myself watching this podcast, we're going to say, hey, I've got capital. I'm going to invest the capital into the debt fund on here. And the debt fund, these are the sponsors. These are the business people. So what they're doing is they're going out there and they're finding borrowers. They're underwriting the loan. They're checking on the property, and then they're issuing the loan to the fix and flipper or the person that needs bridge lending. And then they're lending that to the real estate investing who's borrowing the money. And then that borrower pays interest. And then typically they pay the principal back once the loan comes to terms. Like, hey, they sell the fix and flip, or their bridge loan, their temporary financing for their multifamily is over. They pay all the money back at once. So the debt fund goes out there and then they collect the payments. They manage the loans. They make sure it's all performing. And if there's issues or foreclosure, they handle all the details. And then what they do is they pass on some of the interest back onto the private investors. And then so a lot of times these debt funds are usually quarterly interest payments. Some are monthly, some are longer, but I'd say quarterly is the most common that I've seen. Have you invested in debt funds before?
That's 100% what I referred to at the beginning, and now I know what it's called.
Yep. Okay.
So yeah, it's like guaranteed 10% return until they could refi the entire, and then I have an opportunity as the initial investor to roll that into LP or equity in the future project. As far as I understand. So,
yeah, that's exactly how it works.
Yeah, that's cool.
And so there's a lot of different nuances on the structure, but this is like the 30,000 foot view. And I started investing in debt funds about 2 years ago, and I fell in love with them because that's where you can find cash flow nowadays.
Oh, yeah. Yep.
Now, there's the reason I like debt funds because you can invest in a debt fund or you can lend on a property directly yourself. I don't like lending properties directly myself because A, I don't want to, that's not my business. And B, hey, if I lend $100,000, I'd rather have that spread across multiple properties versus just your fix and flip, Tyler.
Diversify.
I want diversification. Exactly. Yep. So like for a debt fund we work with here, we generate our returns and focus on diversification through multiple loan programs across multiple borrowers, multiple properties, and multiple markets. So like we do some value add loans like the fix and flips. Permanent financing, so these are like have you ever heard the term like DSCR loans, so non-traditional long-term banking, and just some opportunistic loans where there might be an issue with title on the property. There's something where like, hey, the property itself is great, but there's something paperwork that's causing up issues. And a traditional lender, they cannot lend on there, but a private lender will be like, oh yeah, hey, all I have to do is clean this up. Okay, that's like $20,000 in legal work in 6 months. We'll lend on that. So they fill these needs. So we have multiple lending programs on there across multiple markets. And so going back to the Property Llama demo on here, I'm going with the theme.
So that is hard money. You're basically a hard money lender at that point with the opportunistic loans.
Yeah, it's all,
Got it.
Hard money or private money. It's all, there's specific
money.
nuances, sure. But for our case, it's all about the same.
Yep.
It's coming from a non-traditional bank.
Yep.
And those are people that can, close fast.
Oh yeah.
And then a lot of times the borrower is going to pay like anywhere from like 1 to 4 points of the loan, and their interest rate will be 8 to 15%. But they have the terms that they need to go out there and close on the property. So on like this debt fund, for example, hey, it's a 12, pays back a 12% cash on cash return. And depending on a lot of times how much you invest or the length of the lockup period, things will range. But a lot of times these funds will pay anywhere from about 10 to 12%. It's very common. And so with this one, you invest this year, you get 12% the first year. Now you may have the option of like, hey, taking those as quarterly dividends, or it could just like you could reinvest and compound in there. Most programs or most debt funds just pay it out. But that'd be you invest $1 million, $120,000 in year one, $120,000 in year two, $120,000 in year three, $120,000 in year four. And so as long as your cash is invested in there, you're getting that return. It's just like being invested in a bond, or being invested in a CD, or being invested in a savings account. Now, the rates usually don't fluctuate like a savings account will or a bond will, but it's that same concept. Hey, you just get this fixed monthly or fixed quarterly payment. Now on here, you get the steady stream of income, but there's no price appreciation. There's no tax benefits. There's no equity you're building. You're just getting straight interest, or as I like to call it, you're getting straight cash flow. So $1 million out there, you're going to get a 6-figure cash flow check every single year. So to kind of start wrapping this up here, I want to show you how this looks like from a portfolio architecture standpoint. Because in the beginning, we talked about, you want to have a diversified portfolio and you want to have it, across multiple assets, some on equity, some on debt, and then creating the right portfolio architecture for what your investing goals are. And so I put this one together. And if you take all four on here, so, for this, you got $4 million, $1 million to multifamily value add, $1 million into development, $1 million into development, $1 million into the cash flow. It should be making about a 20% IRR over that 5-year time frame. Well, if that hits it, that means in 4 years, your money has doubled. So, hey, in year one, you're getting 20% back between cash flow and equity growth and all that. So by year 4, all that money is doubled. Now, typically, most real estate deals are between that like 17 to 20% on the equity side, sometimes a little lower, sometimes a little bit higher, but very common the equity side. Like I said, the debt side's more like the 10%-ish range, but you blend those together and your money should double in that 4 to 5 year range, which is always my goal. I also think it's kind of like the sweet spot for real estate investing where you get strong returns while also kind of keeping your risk mitigated. So, all right, I know I fire hosed you, Tyler, and some audience on here. What questions or thoughts do you have on here? Because I rambled for a bit.
Questions that come up are, so in the last model that you showed where you get 12% return, let's call it hard money or the equivalent of,
yep.
Right? So in this model, does it vary from deal to deal? As an example, if a founder just has a sale, they say, I would love $120K a year for putting in $1 million for the next X amount of years, understanding they're not getting tax benefits, equity, etc. If that model doesn't refi the loan or pay them their dividend out, does it always automatically continue compounding, or is that on a deal by deal basis?
It really depends on how like that fund is structured.
Okay.
So, a thing about these real estate investments is, I put together these real estate deals. I'm a GP in a lot of these deals. Most of these people, and myself included, we're not licensed by the SEC, so we're not money managers.
Sure.
So before a person invests in the deal, you get usually the PPM, which is the private placement memorandum, and it tells you exactly everything works out on there.
Yep.
So that it should be structured to you. You should know it before you get into it.
Of course, yeah.
So from a high level, though, what I've seen, most pay out quarterly. As I'd say, the most common to kind of give you like the general rule of thumb out there. Most debt funds pay out quarterly. Mm-hmm. So, the sponsor or the debt fund, they're the ones kind of taking the risk from month to month in terms of like, hey, if they are not deploying all the capital or they have some unexpected cost or a loan goes bad, they've got their margins built in there, so they're absorbing that. And then most debt funds are paying their investors a fixed return. Mm-hmm. Some debt funds will be variable, but I'd say like 90%, if not more, kind of pay a fixed cost or a fixed amount.
Yep.
Because most people want to know, hey, what am I getting every month? They'd rather have certainty versus variability.
Yep.
Now, what happens on there is, let's say one of the loans they give out, they have to foreclose on the property. Mm-hmm. And I'd say most debt funds, they're going to have like a foreclosure rate of like 1 to 3%. So if they invest with 100 loans, 1 to 3, they'll have to foreclose on the property, meaning the borrower can't pay it back. Well, that should not affect the return of the investor like you and me on there, because we have our fixed return. Mm-hmm. And then most hard money lenders actually make monies on foreclosures because they're going to underwrite, hey, if I have to foreclose on this property, I want to make sure I get my money out and make sure the legal fees and headaches for foreclosing, I can pay those bills on and make some. Mm-hmm. So the funds I've invested in, when they've had to foreclose, they've actually made money on those, which just means they have a good business model. Now, most lenders, they don't want to foreclose on their properties, but it's just the cost of doing business when you're a lender. So they have that built into their pro formas.
Yeah. I was thinking about funds just on timing, given the market's rates jacking up, right? So you could find some of these deals, they'd guarantee 10% a year or whatever that is. And then all of a sudden rates just go haywire and they're like, whoa, we can't make those payments or those distributions. And they have a hard time refining, right, to get the actual initial debt. So yeah, that's where that question came from.
Oh, I see. Yeah.
Yeah.
And that's usually, so a lot of the hard money, like this one, that I've invested in, other ones, like a lot are, a lot do like residential fix and flips.
Sure.
I'd say they're much more like bread and butter.
Yep.
And when you're the bank or bread and butter, like kind of boring is safe.
Sure.
And so a lot of them are like, they're not out there doing, crazy loan structures or high risk ones.
Mm-hmm.
There are definitely lenders out there like that. But I think when you look at anything in real estate, especially like a debt fund, the preservation capital is the biggest thing.
Yep.
Let's not lose money.
Right.
And so like I've seen ones like, oh my gosh, they're doing much riskier loans. It's 3x the risk, but the return's like 20% more. Well, that risk reward ratio is out of whack. Why would you do that? I'm going to take 3x more risk for like 1.2 more return.
Right.
No, not going to do that.
Right.
So,
yeah.
Yeah. And then you got any other questions or comments on here, Tyler?
I don't believe so.
All right.
Yeah.
So this has been a lot of fun, and I appreciate you taking the time having me on, Tyler. And I very much appreciate you sharing this with your friends and family, man.
Yeah. Thanks for doing all this with me. Appreciate
You bet. And I'm going to have to come on and you can do a webinar on the private equity side now.
Sure.
Like I wanted to like talk to you about the whole time on here, but I kept the game plan on real estate.
Yeah.
All right. Thanks a lot, everyone.
Thank you.